What is up? Happy New Year. Technically, we're a little bit past the new year, but this is our very first video, of 2023. So I guess, Happy New Year. I hope everybody had a really great holiday season, and I hope that your 2023 is off to a really strong start. My name is Adam Balsinger. This is the Investor Boardroom channel here. And what we really focus on here at the Investor Boardroom is real estate investing, specifically multifamily real estate investing, okay, and commercial real estate investing. Now, on this channel, for the past a little over a year, we've been sharing all kinds of information pertaining to multifamily real estate investing and commercial real estate investing in general, investing in general. Our ultimate goal here in everything that we share is to help you, our audience member, to get one step closer to what I believe is the ultimate goal, or at least what most of our ultimate goals should be, and that is financial freedom. I don't know about you, but I have zero interest in trading time for money until I'm 65 years old. That does not sound like a whole lot of fun to me. I am of the belief that there's a lot of other people out there that don't want to kind of follow the system that's been created for us. And I believe that there are much better ways for us to go out there and achieve that financial freedom and create that freedom for ourselves. And I believe that real estate investing is one of the absolute best vehicles to get not only myself, every single one of our investors, and even you, if you have no idea at all about real estate investing right now, I believe it's probably one of the best options for you too. Now, over the past year plus, we've handled our content on this channel in a very specific way. And I wanted to change that up a little bit here in 2023. So one of the things that I see, right, I'm an entrepreneur at heart. I'm an entrepreneur before I'm a real estate investor, which is really funny because I have like 3 real estate businesses right now. But so one of the important things that you have to do as an investor, as an entrepreneur, is you always have to be kind of surveying the competitive landscape, because you could be employing a great strategy, but if everybody and their brother is employing the exact same strategy, then you're competing with a lot of different people, and that strategy's overall effectiveness and profitability may be negatively impacted just because of the sheer competition in the space. So I'm always paying attention not only to strategies and learning new ways of doing real estate deals, but I'm also paying really, really, really close attention to what all the people out there that I'm kind of competing with, what they're all doing. We've probably all heard the saying that when everybody's running in one direction, the prudent thing to do is to go the opposite way. So one of the things that I see, if you are a stock market investor, it's very difficult for you to turn on the news or for you to go to any kind of stock market or market related content without seeing news, today's news, recent news, and how that overall is going to impact particular stocks, sectors of the stock market as a whole. I don't really see a lot of the same thing as it relates to real estate investing, and I think that I could be a great source to kind of fill that gap. So we're going to continue to talk about all kinds of different topics as it relates to investing, real estate investing, commercial and multifamily investing. Our goal still is the same, to help you get one step closer to financial freedom, but we're going to provide some tangible news information that's affecting real estate today and into the future. So this is the first time we're doing it. I hope this works okay. Typical entrepreneur, right? So we're trying something, we're going to see how it works, and we'll pivot and we'll tweak if we need to. I'm hopeful that this is going to be really valuable to you as a listener to help understand kind of all the different things that truly do impact real estate here in this country. So without further ado, what we want to start out with here is, it helps if I know what I'm clicking on. We're going to start out by looking at the expectations for the Federal Reserve and interest rates here in 2023. So last year was not exactly a great year if you're an investor. Stocks were down, crypto was really down. Precious metals kind of stayed relatively flat. Real estate could be up, it could be down, kind of depending on where you're invested. And, if you're in a REIT or a fund, or if you're with a private, in a private offering. So there's a little bit more variables at play there, if you will, when we're talking real estate. But the interest rates here and what the Fed decides to do this year is going to have a definite impact on real estate and the overall economy as a whole. So we saw 2022, we saw crazy rate hikes, historic rate hikes, historic how quickly they raised them, how aggressively they were raising them. And so part of the question in 2023 is this going to continue, and how much so is it going to continue, right? So here's the expectations. As of right now, the Fed is at 4.24 to 4.5. Okay, so here it is. Here is the federal funds rate target range, 4.25 to 4.5. So what is going to happen here this year? Now, this is all essentially kind of expectations and assumptions based off of what the Fed is telling us and a lot of the other variables that are at play here. The job market, right? Inflation, like there's a lot of things that the Fed looks at, and they may be saying one thing today, but then fast forward 6 months, they may wind up doing something else. Okay. But so this is being based off of a variety of factors right now, as well as then what the Fed themselves are saying. But so most people, the consensus is that the Fed is going to continue raising rates in 2023. What the expectation is and how aggressively they will raise them, there isn't a great consensus, but the average that I'm seeing is right here, that we will be expecting to hit a 17-year high of 5 to 5.25%. Now, you can also see here in this instance, this expectation or this projection is 4.75 to 5. There's also one that I saw that was 5.25 to 5.5. So you're getting all kinds of different perspectives. On the low end, I've seen 4.75. On the high end, I've seen like 5.5. But so what that means is that we've got about another 100 basis points, give or take, depending on where in that range we fall. What I'm really seeing is most are expecting it to be another 2 rate hikes of approximately the 50 basis point or an interest percent, per rate hike, with then rates kind of leveling off mid to end of the year, with some rate cuts beginning end of this year or beginning of 2024. So that right now is the consensus with what we're seeing. Now, let's look at some of the other things that are influencing this. Now, the December jobs report. Now, the December jobs report data that came out was pretty positive. Over 220,000 net new jobs were added in the month of December. Now, these are projections that the government comes out with. A lot of times these projections almost every time they wind up coming back and correcting them, essentially after about a month. So they may revise the numbers up, where we actually wound up with more jobs added, or they may revise the numbers down. Now, my expectation is that the numbers probably going to be revised down. Now, that may wind up impacting what the Fed decides to do. We'll see. But the reason that I don't buy this 223,000 new jobs added number is, if you've been paying very much attention, there has been news story after news story about major employers here in our country with job cuts, slashing extensive, significant portions of their workforce. So here's an article from the Indian Express, the journalism of courage. I've never even heard of this place before, but so thousands and thousands of layoffs are going to be coming here. Meta and Amazon are kind of leading the way. So Amazon, 10,000 to 18,000, I've seen upwards of 18,000 jobs they'll be cutting. Meta is chopping 13% of its workforce, 11,000 employees. DoorDash is chopping by 12.5. AMC's cutting about 20% of its workforce. And those are just a few. So Kraken is a cryptocurrency exchange. They're chopping 30%. Citigroup is making some big cuts. Morgan Stanley and Intel are making some cuts. Microsoft, Johnson & Johnson, Twitter, like these are massive companies, right? Lyft, Warner Brothers, Beyond Meat, Stripe. We'll keep going here. Coinbase, Walt Disney, Roku, Cisco, HP, CNN. So Salesforce is chopping 10% of its employees, and that may wind up increasing. So when you're seeing all these major employers chopping jobs, it's just really kind of hard to swallow that we added 223 jobs last month. We would have needed to have added a significantly higher number to account for all of these jobs that were chopped here in this article that we're looking at, right? Because it's net, the number of net new or lost jobs was 223. So we'll see what winds up happening. I would anticipate that number is revised down, which just increases the scare and the likelihood of a pretty rough economic situation that we're going to be running into. Recession, right? We changed, I say we, the definition of recession was changed at some point last year. So if you're going based off of the old definition, we're already in a recession. If you're going based off of the new definition of recession, it's up in the air, whatever. So a recession would be bad, right? Never good. So let's look at some other things. So apartment rent growth. So apartment rent growth has really, really helped multifamily investors over the past couple of years. 2020, 2021, even last year, 22, we saw some really incredible annual rent growth data. Now, that is a major tailwind for commercial real estate and commercial multifamily real estate because these pieces of real estate are evaluated based off of the income that they generate. So if you think about it, if rents are going up by 10 to 20% without doing any major renovation to the property, then in theory, your income would go up with a relatively similar percentage, right? Maybe not the same 10 to 20%. Your expenses may have gone up a little bit, but if you have a 20% increase in rents, then you can expect that your property is going to create a lot more, spit off a lot more income, which is going to increase the value of that property. Now, one of the things that my team and I have been saying over the past few years is that, yeah, while we're experiencing this incredible historic rent growth, it is simply not sustainable, right? So what we're now seeing is these rent growth figures are starting to come back to earth, more in line with your historical norms. So for people out there that are expecting these rent growth figures over the past 3 years to continue, you're probably going to be a little disappointed. Now, if you're aware of that and you were looking at deals with the expectation that those rent growth figures were going to come back to earth, then you're going to be okay. But if you were looking at deals over the past 2 or 3 years, expecting that rent growth to be the new norm, then your deal could really, really be in trouble if that rent growth plateaus, or we may even see, it's theoretically possible, rents could actually retreat a little bit before they find some form of equilibrium. This could be bad overall, depending on how you were looking at your deals and projecting your rents. And then to further complicate the whole rent growth question, what we're seeing is that over the past 2 years, there has been a crazy amount of multifamily apartment development. Now, we have been at a supply and demand imbalance for the past several years. We simply did not have enough apartment supply to keep up with the demand. Well, now you can see here, this is according to CoStar, which is a commercial multifamily data, right, provider, that multifamily is bracing for a deluge of new supply in 2023. The highest level of new construction units hitting the market since 1980 something, over 40 years, right? And so what this means here is that as more of these units become available, the supply and the demand imbalance is going to find more of an equilibrium here. So one of the reasons that you were seeing the crazy rent increases was because of the demand for these kinds of units. It was kind of in conjunction with inflation. You had like this double-edged sword leading to these crazy rent increases, right? But so now we're seeing people losing jobs, right? We just looked at that article. We're seeing a lot of brand new supply hitting the market. Most of these new units are in the Class A sector. So these are like the luxury apartments, the high-end apartments. And the reality is that you only have so many of those potential tenants within that demographic. So I really think what's going to happen here in 2023 and into 2024 is these luxury apartment complexes, you're going to see rent growth totally plateau. You may even see it retreat. You're going to probably see a lot of concessions in order for these developers to be able to fill up these apartment complexes. We have not seen the same crazy amount of development here in kind of the affordable workforce housing type of product, right? These are typically referred to as like your C or your B class type properties. So we really we're very much still active in the market. So sorry, let me pause, right? And we're going to transition here. Let me stop my screen share. So what our expectation is for 2023 is that deals are going to be hard to come by. There is a definite delta right now in what sellers' expectations are as they look to sell inventory versus what buyers' expectations are in terms of what the pricing should be. As a result, I think that you're going to see a lot of deals hit the market in 2023. I think a lot of those deals are not going to sell. I think that what we're going to see in 2023 is there's going to be a lot fewer transactions that take place, and the only people that are going to be selling are going to be the people that need to be selling. So I think you're going to see the transactions decrease pretty significantly. The lending environment right now is much more complicated for lenders, or excuse me, for borrowers out there. So we looked at a couple deals last year, and we were seeing, even while we were working on our projections, we were seeing rate changes and proceeds that lenders were providing were being slashed. So lenders are a lot more nervous. So it's going to be harder to do deals out there. And our team, we totally anticipated that. So one of the things that we started to do closing out last year, and we haven't done this in quite some time, was we started buying more very small residential properties. Prices are dropping there. We've been able to pick up a handful of properties there. We're leveraging our investor base to come in and to invest in those deals with us as private lenders. So these deals are incredibly safe because our investors on those kinds of deals are getting first mortgage position. So they're literally playing the role of the bank. Right? Being the bank right now would be a really, really, really good place to be. So we're doing some more deals. Those deals are way, way, way smaller. I'm kind of going backwards almost in my experience, because I used to do those kinds of deals as I was building a portfolio years ago. So we're doing those deals more. We have kind of redefined our buy box here because of the expectation that we have about competition in the space and where the opportunities are really going to be in 2023. And so we've adjusted our buy box. We've adjusted some of the things that we're looking for. We're looking for severely distressed assets. We're looking for assets that are going to spit off a lot of cash flow, or we're looking for assets where we have the ability to come in and assume a low interest rate on a fixed mortgage on a property. We're able to come in and assume that mortgage, that low rate. So we have, kind of looked at everything that we perceive that's going on in the market right now, how it can impact us, how it can impact our investors, and we're acting accordingly here moving into 2023. I am super excited for this year. I think it's going to be a great opportunity for a lot of people who are prepared and who have really looked at things and are approaching this year strategically, I think it's going to be a great way for them to really be able to add to their net worth, create a lot of additional new passive income, and put themselves on a really strong position moving into, as I said, that ultimate goal of financial freedom. I hope that sharing some of this stuff here and showing some of the information to you, these things that are impacting real estate, I hope that this was valuable. Please let us know in the comment section if you liked this new video, okay? If we get a lot of positive feedback, then we'll continue doing this here for the remainder of 2023. Make sure that you understand kind of why we're thinking what we're thinking, where we're coming up with these ideas. I think it really just helps to kind of paint that bigger, more clear picture as to what is driving our thinking. So with that being said, that wraps it up for our very first video of 2023. We wish you all the best in your investing. Please don't hesitate to reach out if there's any way that we may be able to help you. Also, feel free to check out our website. If you're interested in potentially investing in real estate, you can check out our website. You can learn more about who we are and what our track record is. We're always looking for potential new investors. It's not an immediate thing. We structure our deals in a way where we allow non-accredited investors, which is a fancy way of saying people that aren't already rich. We accept anyone into our deals that we possibly can. There are some rules that the SEC, the Securities and Exchange Commission, put into place that make access to really neat and cool alternative investments very difficult if you're not an accredited investor. You're not somebody that's already wealthy. So we have to kind of jump through a couple of different hoops. Like, you'll never wind up seeing on any of our content us promoting an investment because we can't. We're not able to do that. So if you're interested in potentially learning more about investing with us, check out our website. There's ways there for you to join our newsletter. There's also ways there for you to be able to book a phone call with us to learn more about what it is that we do and how we help our investors. That's the way that we have to do business in order for us to stay compliant, because we choose to allow not already rich people to come into our deals. So we would definitely appreciate you checking us out, and we would really relish the opportunity to talk to you about your investing and see if there's any way that we can help put you on a path to financial freedom. So with that being said, please do us a solid, give us a like, subscribe to the video if you haven't already, share this information with somebody else that you may think will get value from it. And with that being said, I hope you have a fantastic 2023 and beyond. See ya.